Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. While weeks in 2022 have been terrible for mortgage rates, I've always been able to say at least it wasn't as bad as the 1 week in 2013. I can't really say that anymore. Sharply higher rates out of the gate last Monday, a few hopeful days midweek, then another terrible day on Friday. It's both simple and complicated. The simple part of the explanation has to do with the Federal Reserve making several unexpected adjustments to its policy outlook. Fed policy involves setting the key overnight lending rate in the U.S. as well as deciding how to buy and sell large amount of certain bonds. In addition to U.S. Treasuries, those certain bonds include mortgage-backed securities, which directly dictate mortgage rates. And as such, the Fed bond buying outlook has a very big impact on mortgage rates. If the Fed gives the market a reason to expect smaller MBS purchases, rates rise. The bigger the surprise relative to previous expectations, the bigger the reaction in the mortgage market. Starting in November 2021, the Fed began reducing the size of the bond purchases that began at the start of the pandemic. This was bound to happen at some point, but November was a bit earlier than some of the market expected. As a result, MBSs suffered. Then in December, the Fed announced it would decrease MBS purchases at a faster pace. This wasn't really the end of the world at the time, because even after the Fed completely eliminated its scheduled bond purchases, they would still be reinvesting the proceeds from previous investments. That sounds complex, but here's a simple example that should help clear things up. Imagine the Fed is your mortgage lender. As you make payments, or if you sell or refi and pay your loan off completely, the Fed will take that money and then use it to lend to someone else. This is exactly what's happening with the Fed's reinvestments, but on a grand scale. In this way, the Fed is not buying any new MBSs. They're simply replacing MBSs that would otherwise fall off its balance sheet. These reinvestments account for a substantial amount of buying demand in the bond market. And bond buying demand equal lower rates, all other things being equal. The last time the Fed bond buying fell into reinvestment only status, it took years for them to finally put caps on reinvestments each month. In doing so, they began to gradually shrink their MBS holdings. The technical term for this is balance sheet normalization, or simply normalization. Mortgage rates didn't love the idea, but it was gradual enough to be tolerable. Plus, the market had years to prepare. On January 5th, 2022, the minutes were published from December's Fed meeting. The minutes can reveal any additional details that didn't make it into the official policy statement, and that's exactly what happened in this case. The market learned that the Fed was discussing shifting gears into the balance sheet normalization phase much faster than precedent suggested. To make matters worse, the committee had been discussing a faster pace of rate hikes than markets expected. Now, granted, the Fed funds rate doesn't directly dictate mortgage rates, but if the market suddenly expected more or faster hikes, interest rates tend to move higher across the board. The following chart helps you visualize this in terms of the mortgage market. The higher the blue line, the higher the mortgage rates are moving relative to other rates. As mentioned in the chart, scary inflation data is a problem for the Fed's rate hike outlook because controlling inflation is one of the Fed's two key policy goals. Incidentally, the other part has to do with full employment. But since there are more than 100 jobs out there for every 60 people without one, the Fed is understandably just focused on inflation at the moment. And inflation is, well, out of control. These next statements, more than anything else in this video, sum up the big problem for rates in 2022. When something happens that increases inflation expectations, whether it's a new economic report or an unfriendly policy that indirectly affects the price of commodities like gas and oil, or a pandemic that affects the price of so many other things, the market responds by adjusting its expectations for Fed rate hikes. Those expectations translate directly to how actual interest rates are moving. Fed speakers add fuel to this fire by confirming that the market is right to be afraid both of rate hikes and balance sheet normalization. Now, to be fair, it wouldn't have been as big of a problem if the Fed had been more aggressive in combating inflation in 2021. But policymakers were afraid of shortchanging the economic recovery when new COVID variant risks weren't as well understood, and it's not friendly to raise rates when so many were getting government checks. Even then, the Fed likes to move slowly and predictably. Unfortunately, that approach has proven to be extremely ill-advised given the current market dynamics. That was already true before the Ukraine war, but doubly true after. The result is a rapid repricing of expectations as the market moves as quick as it possibly can to get in a position for the Fed's probable rate hike path. The following chart shows exactly how traders have been adjusting to their bets on the Fed funds rate at the end of 2022. This is an extraordinarily fast shift in rate hike expectations. With the Fed funds rate currently in the 0.25% to 0.5% bracket, it would require 8 rate hikes in the standard 0.25% amount to hit the year-end target. There are only 6 Fed meetings remaining, so at least 2 of those meetings will require a 0.5% hike. It's been more than 20 years since we've seen a 0.5% hike. Now markets are expecting 2 of them in relatively short order. There's even been talk of a 0.75% hike. It's this rapid repricing of expectations that makes things so volatile right now. Again, the Fed funds rate doesn't directly dictate mortgage rates, but this unprecedented shift is sending shockwaves throughout the rate markets. Mortgages are taking some of the extra damage because they're more reliant on Fed bond buying than treasuries, and the Fed stated a preference to hold only treasuries in the future, which is a double whammy. The net effect for mortgage rates is the fastest spike since 1994, assuming a time frame of several months. In terms of a single week time frames, I figured the record set on Friday, June 21st, 2013, would stand for a long time, and that nothing else would ever really come close. The good news is the record, 0.52%, still stands. The bad news is that after this most recent Friday, the record still just barely stands. The average lender moved higher by 0.49% this week. Considering mortgage lenders offer rates in set increments of 1/8%, this is basically a tie. The average borrower would see a rate quote that is a 0.5% higher this past Friday versus the previous Friday. Moving beyond a week time frame, and nothing else in more than 25 years even comes close, you'd have to go back to 1994, and even then, it's a close call. There is hope on the horizon. However, it may sound trite, but the higher the rates go, the faster they get there, the sooner the next period of relative stability can begin. This can happen even as the Fed continues to hike rates because the mortgages and treasury markets are making immediate changes based on future expectations. When the future plays out as expected, it doesn't imply any change to the rates we're currently seeing. This doesn't mean rates won't go any higher, but it does mean that they've clearly already put a lot of work toward reaching their next peak. Any additional surprise will depend on incoming data and events, especially inflation-related data and geopolitical events that greatly affect the outlook for growth or inflation. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Till next time, take care and stay safe.